welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of non-dollar rate strategy, and I'm joined today by our global market specialists, Joann Spadigam and Kevin Cummins. Okay, I'm going to start with you, Joann, because I feel like, well, the ECB is next week, so that's probably as good a place as any to start. It's obviously the much anticipated June meeting. They have been signalling for, well, at least a few weeks now that they intend to cut rates in June. Is that still your base case? I guess I'm asking that in light of inflation data this week and also wage data last week that both have so far come a little bit higher than expected. We're recording this on Thursday as usual, so we don't yet have the euro area print, but we have had some national prints that can feed into our estimations for that. How do you think it's feeding into the ECB's decision-making process?
Yeah, I think we've been waiting for quite a while for this June cut to finally materialize, and I suppose somewhat surprisingly it is, or seems to be based on what the various ECB speakers are telling us. I think the data's been fairly interesting. Obviously, I think last week when we had that wage inflation data that was slightly higher than expected, we did see the ECB come in and rebuttal that quite quickly after with that wages blog. I think in terms of the European inflation prints for this week as well, as you said, both Spain and Germany did come in slightly higher than expected. So we think overall we should see a 2.6% print tomorrow, which was our base case, but slightly higher than the market. But I think overall it doesn't really shift the narrative too much for the ECB. This bumpy last mile and an increase this month and perhaps even next month was fairly well televised just because of the energy base effects. So I do think that the overall impact on the narrative has been fairly muted. What we will get in June as well, alongside the rate cut, will be a revised set of forecasts as well for the ECB. And the growth data that we have has surprised slightly to the upside versus the ECB's forecasts, whilst the inflation picture seems to be more or less in line with what they've said in the past. So really the data is more or less tracking the ECB's forecasts and what they expect. So we don't really expect too many surprises at that next week's meeting. And we also expect that the data has really solidified the case for a cut, even though, I think the main way in which it changes the ECB's narrative might actually be in terms of the amount of cuts for this year. So obviously we've had slight upside surprises, which means that, the July meeting may be one where we see actually a skip and no cut coming in for July, just on the back of that data as well. So I think overall for next week, not many surprises to come, but probably July is a skip at this stage.
How does that leave your outlook for European rates in general? I mean, the market has kind of moved to that central scenario of, a cut in June and a skip in July. But, we've had a big shift in yields over the last couple of weeks. We're much higher in 10-year bonds, for example. The curve has finally started to steepen up a little bit. What are you thinking, I guess, across the curve for European rates?
Yeah, so I think there's mainly two factors at this point that determine where the 10-year yield should sit. The first is, of course, our expectations for the ECB, and the second is supply. And I feel like for a lot of this year, it's really been that front-end expectation that's driven the curve. And most importantly, I think, led by the US and US data. So I think, we've seen a big retracement in even the front end in Europe, where, the amount of cuts being priced into next year is also significantly lower than it was over a month ago. So, I think that the front end has moved quite a lot in sympathy with this US story. And the question, I suppose, for now is, do we actually get a series of cuts, or do we just get, this adjustment cut at this stage? I think given why the inflation data is in Europe, and the fact that, that is really coming in line with what we expect, and the fact that, European inflation is quite different from the US and the UK to some extent, we do think that the case for cuts is very clear in Europe. So we think that, when the ECB does cut, that does come with a series of cuts. So we do get cuts in June, in September, and December. So all of the forecast meetings that are more priced in at this point in the market. And I think what's interesting as well is, what the market is priced for at this point, at least in terms of cuts for this year, is on the hawkish end of ECB speakers' expectations. So the market's pricing in around 60 basis points in cuts for this year, which is what hawks have been saying is their base case. And I mean, if that's what the hawks are thinking, two or three cuts for this year, what are the doves thinking? So I mean, I think there's obviously lots to consider in terms of US policy going forward and over the second half of the year. But I think from where things are at this moment for Europe, we do think that there is this case to make for more than just these adjustment cuts at this stage. So to me, the front end is perhaps pricing in too little in terms of ECB cuts just based on the European picture. And that does as well inform where we see longer term rates in Europe as well, just given how correlated the two things are. So I think in the short term, the direction of travel for yields in Europe is lower. But obviously, I think moving forwards and zooming out a little bit into the rest of the year, once we've started the rate cutting cycle, once the market starts to price in the front end more fairly in Europe, I do think, towards the back end of the year, the supply story will once again return and be another driver of the back end of the curve. So, I mean, I think the story is kind of similar as we've said in the past.
Touching on supply then a little bit, because obviously away from the ECB, one of the other themes, or I guess conversation topics this week has centered on France's rating review. Tomorrow, S&P will rate France following Fitch and Moody's a couple of weeks ago. Obviously, concerns are high given the fiscal outlook and the revisions to France's fiscal outlook over the last couple of months. Are you expecting a ratings downgrade? And if so, how impactful or how meaningful do you think that's going to be on French bond spreads?
So, I mean, I think that the France kind of rating story has obviously been in focus quite a lot over the last month. And I think the S&P, which is due tomorrow, is the one rating agency where we thought that there was the largest chance of a downgrade, just because the outlook has been negative for quite some time now. So I think our base case for tomorrow is that actually we do see that downgrade materialize. But I think in terms of market impact, I think it's more or less expected that this will happen. So I think that the market impact, if any, will be quite small. We're likely to see a bit of a widening in France versus Bunds, for example, on the back of that rating downgrade. But I do think that it will be fairly temporary in nature. I mean, I think it's been a pretty positive atmosphere in general for spreads, and that should continue going into the rate cutting cycle. So I think versus Bunds, there might be some widening, but I do think that that will be temporary. I mean, we've talked about this before as well, but France does seem still to be that underperformer versus other EGB spreads, both in periphery, for example, or even semi-core. So we do expect that France will continue to underperform versus other EMU 10 peers. By this stage versus Bunds, the picture for spreads is still very much positive.
I think the market likes to get very excited about the risk of downgrades, but it's a useful reminder, I think, that rating agencies are really only reacting to information that we all already know. And so, in theory, the supply risk or the fiscal risks that are triggering the downgrade should already be priced in. And it's not like we're talking about France. I think it's probably fairer when we thought, when we previously considered the downgrade risk around Italy, for example, and BTP's Italian sovereign bonds, the risk of them falling from IG investment grade to high yield. But actually with France, even, in the case of an S&P downgrade, it's not taking them into or out of any particularly important ratings brackets. So sometimes it feels like the excitement around rating action could be a little bit overdone. Okay, let's move over to the US then, Kevin. It's been a little bit of a quiet week as we kind of await that key data on Friday, the core PCE, which the Fed has obviously, previously identified as its preferred gauge of inflationary pressures in the economy. We're recording this on Thursday, so by the time lots of people listen to it, they will probably know what that print has been. But perhaps we can just talk briefly about your expectations, but then perhaps more importantly about how you think that sets the Fed up going into their June meeting.
Yeah, sure. So this morning we had a revision of Q1 GDP. And I think, it's very much old news by now, kind of backward looking. But one of the things, because obviously the Fed has been so honed in on the inflation data, was looking to see if this morning's GDP report had any implications for the April core PCE data on a monthly basis, as you mentioned. And our take on it, while there was a slight downward revision to Q1, core PCE prices were revised down a tick to 3.6 from 3.7 in Q1. That didn't change the backdrop going into tomorrow's report all that much. So we still, on a month-to-month basis, look for some progress in April. We've got it up 0.2 on a month-to-month basis. And if we're right, the year-on-year pace should slow to 2.7 from currently reported 2.8 in March. In fact, I would think because of that stickiness in Q1, that they're probably going to trim the number of rate cuts, it seems like is a lock for sure, this year down from 3. And I think the debate is whether or not they go to 2 or 1. And, you know, I think for reasons of having more optionality, they probably only get it to 2. But I think it's probably going to show a very even split between policy members, whether or not, you know, they want 2 or 1 this year. Sort of like what we saw in the March meeting, where it was a very close split between 3 cuts or 2 cuts. So, you know, I think they kind of push that out a little bit and show only 2, but very close number of officials probably at the 1 mark. And that would be consistent with the idea of having to nudge up their estimate for the end of year, just to kind of lend some support to that expectation of, you know, keeping or lowering that path of easing this year, that they probably nudge up their number for on a Q4 over Q4 basis, which they had core PCE prices at the end of this year as of March at 2.6. I would think they'd probably nudge that up a little bit, given that the numbers have been a little bit stronger than they expected since then. So, you know, not too many major takeaways from this. I mean, the Fed's probably going to need to see sustained improvement on a month-to-month basis. Unfortunately, the year-on-year numbers are going to probably remain pretty elevated over the course of the next few months, even if you get some improvement on a month-to-month basis. So, you know, I think they're not going to signal that they're in a rush to begin the easing cycle just yet. It's clear, you know, whether or not if they get that sort of improvement on a sustained basis, or, you know, I guess there is the risk that you could start to see, you know, better than expected inflation data, even if we, in our forecast, we have gains roughly for the next 4 or 5 months of only 0.2, which would be a nice step down to obviously the first quarter when it really disappointed. But I think, you know, what perhaps may have been like they need to see 2 or 3 constructive reports on a month-to-month basis. Now that, you know, probably has gotten shifted out to say 4 or 5 months before they can feel comfortable enough as a group where there'd be no sort of dissents at a meeting before they can cut rates. And, you know, that was a lot of the rationale for us pushing out to show only 1 rate cut by the end of the year.
You have been on the road for the last week or so, seeing a mix of clients across the US, the UK, and then the continent in Europe. What would you say are your key takeaways from those meetings, and what are market participants, I guess, most focused on? Would you say they're more in line with your view now that July is quite unlikely and you know, 1 cut in December is perhaps more likely, or were they not even concerned about that anymore and, you know, much more thinking about the election or whatever else?
Yeah, I mean, I think in general, most of the accounts we saw, most of the investors we spoke with, we're kind of split between whether they'd be able to cut twice this year or once this year. You know, obviously the election is on the calendar, and something that I think, as I mentioned, the Fed would probably want to avoid starting an easing cycle. But, you know, I didn't get too much pushback on that idea because it is an interesting one. I think genuinely Powell wants to do what is right for the U.S. economy and will act if he thinks he needs to. In the September meeting, which is like the 3rd week of September, that is right ahead of the annual revision to the GDP, as well as the core PCE data and the overall PCE price data. So, there's some scope there for, fast forward a week or so, and you have, numbers that look differently than what they did at that September meeting. So, I think there was some sympathy to that idea from the folks who maybe thought an earlier cut could come either in July or September to that point. I think there was, a pretty even split for the most part. Perhaps maybe a little bit more positive spin on the outlook for the overall economy in the U.S. And a lot of people pointed to the resilience in the consumer and the strength that we saw in the labor market, throughout at least the first quarter as a reason not to be too concerned about things slowing down. There may be some more evidence more recently. And of course, this morning we had the GDP report that really came in line with expectations, but it was notable that consumption was revised down pretty noticeably for the first quarter. I think the underlying assumption was that consumption was starting the year initially around 3% or so. It initially printed at 2.5% this time a month ago, but then this morning it was revised down to 2%. So there's definitely a little loss of momentum to start the year, even relative to when I was on the road last week. So, I think until you start to see the labor data start to soften, that the majority of people are still, for the most part now, pretty optimistic on the outlook. There was one group of folks who, pointed out the fact that, the immigration numbers and net immigration numbers were a lot stronger in 23 and expected it to continue this year and in future years. But there's obviously a lot of uncertainty with regard to a possible, for example, if Trump were to win the election in November, is that probably going to start to fade as we go into next year and into, future years? I think in the near term, it's a close call whether or not you can assume it's anybody's guess whether or not you're going to see that sort of strength in the labor force. And if it's the case, then maybe, the Fed's optimistic outlook of 2% growth and inflation slowing modestly can continue. I think that would lend to support to that idea that that's much of the reason why we saw what we did last year, because the labor market and underlying labor demand was strong because you had this influx of workers, and it really helped on the labor supply, which obviously helped push GDP really strong, and job gains remain very strong. But in the other direction, the tightness that we saw in the labor market didn't lead to higher inflation, and inflation slowed as below the 2% objective, as I mentioned, on the core PCE in the last 7 months of the last year. So you had this kind of Goldilocks scenario last year. But it's open for debate this year whether or not you're going to have that positive boost on the labor supply like you did last year. So people, of course, are kind of interested, as you mentioned, about the U.S. election. And I'd say it was, given the timing of it, and we really don't have too much to go off yet, just mainly polling data, there was a general interest in hearing our views on that. And I'd say, it should start to pick up perhaps earlier than normal conversation among market participants, because at the end of this month, or actually the end of June, is the first debate at the presidential level. So whether or not you like Biden, he's gotten a lot of money. I think he's breaking records as far as from that perspective. And it would be a kind of a mixed signal to people who, they've had this opportunity to potentially put someone in younger and someone that the general public preferred. But they've avoided that so far. But anything can happen. I would, I remind Brian that anything coming out of COVID, as an economist, is I would refrain from saying anything is impossible in these days. So
lots of moving parts. Okay, yep. Thank you, Kevin.
So moving on to the UK now. Imogen, last week you spoke about your revised up yield targets, but with the sell-off this week, we've seemingly been closing in on them already. So how are you thinking about duration from now onwards?
Yeah, I think closing in is generous because I think we probably already reached them. Certainly at the longer end of the curve, I know that well, I don't know if I gave the numbers on this pod last week, but we talked about the fact that the, upside surprise on inflation and the revisions that induced on our bank rate projections kind of led us to revise up our yield projections as well. And I won't go all the way across the curve, but just at the 10-year point of the curve, we thought that that meant at Q2 yields would actually rise further to around 4.35 before falling back only towards about 4.20 at the end of the year versus our previous target of falling back towards 4%. And as we talk now, I believe that 10-year gilts are probably 4.35, if not slightly higher. So I think there's 2 points that I would highlight here. First of all, that when we spoke last week, I talked about the fact that the reaction at the front end made sense. This revision of market pricing of bank rate expectations. It went from having June kind of 50-50 price and August fully priced for the first cut. After the inflation data, it kind of removed June completely, and August became more like 50-50, with the first full cut not priced until November. And that, I think, you could easily rationalize with what we'd seen in the data. But I did think that the reaction at the longer end of the yield, kind of 10 years and out, was a bit more muted than I might have expected. And I spoke about how we'd got to kind of the lows in bank rate pricing, yet we hadn't reached the highs in yields. And so I'm not surprised that we have kind of seen a bit more upward pressure at the longer end of the curve. We've seen the curve steepen, and those yield highs be, close in on those yield highs this week. But the key point really, I think, for me is that one that we've been talking about for a while when we think about the shape of the curve and the direction of travel of rates moves this year is that for most of this year so far, it's been all about monetary policy. But frequently when we get a kind of quieter period, which arguably this week has been in some senses, it's been a holiday shortened week here in the UK and in the US, it's half term in the UK, so lots of people off on holiday. And of course, the key data, as we've been through on both sides of the euro area and the US, has been very backloaded to the second half of the week. And so when we get those quieter periods without a huge amount of central bank speak, without lots of data to contend with, the market then suddenly can think about other things than just the monetary policy cycle. And that's what we had this week, a return to thinking about those other things. And that other thing that is so important this year is, of course, the supply backdrop, the size of the fiscal deficits, and the difficulty that the market is going to have in absorbing all of that sovereign bond issuance. And that's what really led to a decent curve steepening and yields kind of reaching our target pretty quickly. So it's long been our case that is going to be a driver of higher yields this year across the UK, the euro area, and the US, even in a scenario where central banks are potentially cutting rates further and earlier than markets are pricing. And that's certainly our base case in the UK and the euro area, that markets are kind of still mispricing to a certain extent the central bank reaction function. But the supply narrative, the fiscal outlooks, will keep longer dated yields elevated, even in that rate cutting environment. The risk for me, though, in the near term in the UK, is still skewed, I think, towards upside on yields rather than downside. I mean, our year-end target is only 4.20, which is only 15 basis points away from here on 10-year gilts. So it's not in any case like we're expecting a significant rally. But I think in the very near term, it's kind of hard to see what the drivers for a rally back towards that level might be. And actually, I'm a bit more concerned about risks to the upside, in the sense that although we talked on the pod last week about how we don't think the outcome of the election should be especially market moving. We think the overarching theme of the next government will be, one of fiscal constraint, and whoever is in office has very little headroom and to be able to move the needle in terms of discretionary fiscal policy, which limits the kind of risk, I suppose, to the markets around fiscal slippage and breaking those fiscal rules. Both sides of the political spectrum, both the current Conservative government and the opposition party, the Labour Party, have committed to respecting those current fiscal rules broadly in their kind of current shape and form, which means that I don't think that whoever is in office is going to be able to move the needle significantly on fiscal policy, and markets shouldn't be overly concerned about that. But I do think we're in a period of, a short period probably, but a period nonetheless of political uncertainty. And I think that matters when you consider who have been the big buyers of gilts over the last couple of months. We've had a big shift in the structure of demand of gilts in the UK, which has gone very much from having, traditionally pension funds and the Bank of England being the key buyers, as well as overseas investors, to now having domestic bank treasuries, but also overseas investors coming back to the market in a big way, having seen their demand drop off quite significantly after the political volatility and then the rate market volatility of October 2022. So I think that's a backdrop of some degree of political uncertainty, no matter what the polls are telling us, isn't very helpful for encouraging that foreign demand. And especially although it's easy for us to sit from this perspective and say, a potential shift in power from the traditionally more fiscally conservative right towards the left doesn't matter that much for fiscal policy. Perhaps if you're just, a kind of tourist investor, if you like, in the UK, and you don't know the ins and outs of the fiscal rules and who's going to be doing what, you might just, see the headlines that there's a potential shift in power from the right to the left, and worry about what that means from a fiscal perspective, particularly given how volatile or sensitive, I suppose, gilt yields have been to the fiscal backdrop over the last couple of years. And the second concern for me when it comes to rates in general, and like Joann, you kind of touched on it a little bit, is that we have gone through a cycle, I would say, over the last couple of months of very quickly reassessing globally, central bank expectations. So we entered the year very much, us and everyone else thinking that this would be the year of the policy pivot, and that, we could debate the timing and the size of the cuts and the scale of easing. But we had a relatively high degree of confidence that, rates at the end of the year, across the UK, the euro area, and the US would probably be 75-ish basis points, if not more, lower than where we started. And obviously, as the last couple of months have gone by and we've had stronger data out of the US, but also out of the UK over the last couple of months, and the euro area, as we've been through, we've really reassessed those rate expectations and pushed back the start date of our easing cycle, and marginally in some cases reduced the amount of easing that we're expecting, which is also what the market has done. What I'm worried about now is that we really get to a point where markets no longer think about any cut as being the start of an easing cycle, and more just a fine-tuning of policy, exactly as you talked about with the ECB. They deliver one cut in June and then perhaps don't cut again for the rest of the year, or even just cut once more, perhaps, let's say, in December. And that's certainly not our base case, but I think it's a risk case from a market's perspective, in the sense that we've been waiting for the start of the easing cycles to be the trigger of a bull steepener across curves in general, so front end yields falling more than longer dated yields. And yet, if markets don't think that this is really the start of a meaningful cutting cycle, and just a little bit of fine-tuning policy from very restrictive levels to slightly less restrictive levels, perhaps you don't get that kind of front-end led rally that we've been expecting. And that creates issues as well in terms of, at the longer end of the curve, when we're thinking about all of this supply that needs to be absorbed, and what the demand for duration might look like against a backdrop of actually not expecting significant easing cycles at all, but actually just a bit of fine-tuning of policy. And like I say, that's not our base case right now. We still have, in the UK, for example, 3 cuts this year beginning in August. But I do worry, if you get another couple of months of still strong data, that markets really reassess how they're thinking about this easing cycle, that may not even be a cycle going forward. So rates are, we expect them to remain pretty range bound, I would say, over the next couple of weeks. They're kind of at our end of quarter target. And then over the course of the year, we expect a small rally back down towards 420 and not reaching that 4% level in 10-year until 2025. But I do think the risks are perhaps skewed towards higher rates rather than lower in the near term.
So just sticking with the topic again of fiscal policy, there's also been some focus in the UK on the Bank of England's QT programme in light of the fiscal constraints that the new government will face. So what's your take on the future of QT and the impact that might have on government finances going forward?
Yeah, this is a bit of a complicated topic, so I'm going to try and run through my high-level views quickly, and perhaps if anybody's really interested in the nitty-gritty of quantitative tightening in the UK, they can get in touch. But I think there's a few important things to highlight before coming on to our views around the future of QT. And the first is of why quantitative tightening is costing the Bank of England money. And really, there's two parts of the cost of QT. First of all, what we call the cost of carry. So when the Bank of England bought bonds during quantitative easing, they created reserves which they used to buy the bonds from the banks. And so those banks now deposit the reserves at the Bank of England, and they pay bank rate. So they pay interest on those reserves, which is equivalent to bank rate. For a very long time, those reserves were earning, close to 0%. But now that they're earning, 5.25%, and the stock of reserves is upwards of 700 billion. So it's a pretty costly expense, which is only marginally offset by the coupon on the bonds that the Bank of England holds. It earns interest on those bonds, but that, like I say, is kind of small in comparison to the interest that it's paying out via bank rate on the reserves. So the net interest expense is high, but there's also a kind of valuation on the bond side of the cost of QT, and when a bond redeems, so when it matures, or when the Bank of England sells a bond into the market, more often than not, it's selling those bonds at a loss, which is kind of by design of QE. It bought bonds when rates were low, and it's now selling them back in a high rate environment, but it's crystallizing a loss on those bonds. And the reason that this is such an issue in the UK versus anywhere else is because the way that those QT losses are accounted for is different in the UK, in that the Treasury indemnifies the Bank of England, essentially. And so those losses are covered by the Treasury, and they are counted within the fiscal rules, and therefore create a drag on public finances where, as I already said, that headroom, that fiscal headroom is pretty limited. To put that into context, in the past fiscal year, the Treasury transferred £45 billion to the Bank of England to cover the losses, and the OBR projects that in the current fiscal year it will have to transfer another 35 billion. So pretty sizable losses that are creating a big hit on the public finance equation. The second reason that it's different in the UK is because we don't have a system of kind of tiered reserves or reserve requirements. So if we think about the ECB, for example, they pay 0% on a portion of bank reserves, and then they pay the depot rate on reserves that are held over and above that minimum reserve required level. In the Bank of England, that doesn't exist. They pay bank rate on the full stock of reserves. And so that cost of carry portion of the losses is quite sizable. And then the other difference is that the Bank of England is one of the few central banks to be actively selling bonds back to the market. So that loss on fair value of the bond is being crystallized earlier and in a bigger way, because the bank is selling those bonds back to the market. And so I guess with fiscal constraints being the overarching theme of the next government, the focus has shifted quite quickly to how these costs of QT, given they are so sizable, could be mitigated. And I see three options here, and perhaps I'll go through them in order of likelihood. The first is that the Bank of England just stops selling bonds back to the market. Listeners to the pod or readers of our notes will know that this has been my base case for a while now. The Bank of England vote on the pace of QT every September. So I think come this September, they could vote to stop selling bonds back to the market. That doesn't eliminate the cost completely, that cost on the fair value of the bonds, because bonds will still be rolling off, and that redemption value in a lot of instances will be lower than what they paid for the bond. So they're still crystallizing some losses there, but in general it will be much less than when they're actively selling bonds, because it tends to be the longer dated bonds that they have bigger losses on, bigger mark-to-market losses on, if you like. And so you realize smaller losses just by letting the portfolio run off naturally. It does, however, of course, increase the cost of carry of the portfolio over the lifetime of QT, because you have a bigger reserve stock for longer than if you were selling those bonds down quicker. So that brings you on to the second point, that maybe they could change the way that they pay that cost of carry on the portfolio. Maybe they can change the way that reserves are remunerated. And it's something that the kind of Conservative government had previously ruled out, but maybe with a shift in power, and with Labour looking for ways to increase taxes, and given that, changing the way that reserves are remunerated is essentially a tax on the banks, perhaps this could be one way that they go about that. Now, I think it's important to note that Governor Bailey has been pretty clear that any changes to reserve remuneration is the purview of fiscal policy. It is a windfall tax on the banks, and that has to be the decision of the government rather than the decision of the BOE. And it's important, I think, to highlight that Rachel Reeves, the Shadow Chancellor, has been pretty clear over the last couple of weeks and months that a potential Labour government would be very pro-city, pro-business, and they have no plans currently to introduce a windfall tax on the bank. That doesn't mean that they couldn't do this further down the line, particularly if the fiscal constraints become biting and they need to look for other ways to raise money for discretionary fiscal policy. But I think that it's certainly in the near term, it wouldn't be my base case that they would look to change the way that reserves are remunerated. So the final way then that these costs could be avoided, I suppose, or certainly the way that they could avoid being a drag on public finances, is to either change the indemnity such that the Treasury is no longer on the hook for the losses of QT, or change the fiscal rules such that those losses aren't accounted for and they don't kind of feed into those fiscal constraints. I think that this is particularly unlikely. The current Labour Party are campaigning on economic stability and respecting the independence of the institutions. That's the Bank of England and the OBR, for example, and they're campaigning pretty heavily on respecting those fiscal rules, because they saw what happened in October 2022 when the market perceived the Conservative government to be taking irresponsible fiscal risks. And I think that to do either of those things, to change the indemnity or to change the fiscal rules, would bring into question the kind of independence of the BOE, and the markets will worry a lot about the risks of fiscal slippage, because the only reason you would be taking it out of the fiscal constraint is so that you had more room to spend more, essentially. And I think that goes very much against Labour's current pledge of economic stability and respecting those fiscal rules. So that would be my least likely outcome. But again, something to watch for further down the line if those fiscal constraints become, a problem for the next government. But all in, I think the fiscal drag from QT is set to be reduced, given that I do expect them to stop selling bonds back to the market from September. But I think it's going to be very difficult for it to be eliminated entirely, given I don't think the cost of carry of the portfolios, the way that that's accounted for, is going to change, or the way that the losses are accounted for in the fiscal rules will change. Okay. So that's probably enough for me on the dynamics of QT. It's probably a little bit niche for most people. Thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.